Ever wondered how dividend investing works? Let's start by understanding what dividend yield is. Picture this. You're an investor, and you've just purchased shares in a company. Now, as a shareholder, you're entitled to a portion of the company's profits, which are distributed as dividends. But how do you measure the return on your investment? Enter the concept of dividend yield. Dividend yield is a financial metric that indicates the potential return on your investment in a stock. It's calculated by dividing the annual dividend per share by the stock's current market price, and then expressing that number as a percentage. For instance, if a company pays out $2 per share annually in dividends, and the current market price of the stock is $40, the dividend yield would be 5%. This 5% is essentially the income you, as an investor, would earn from your investment, not accounting for any changes in the stock price. But why is dividend yield important? Well, it's like a compass for investors, guiding them towards income-generating investments. It lets you assess how much income you could potentially earn from a stock relative to its price. Higher dividend yields can be particularly attractive for income-focused investors, such as retirees seeking a steady income stream. Moreover, dividend yield doesn't just reflect potential income, it also provides insight into a company's financial health. Companies with a history of consistently paying dividends are often considered financially stable, which can make their stocks more appealing to risk-averse investors. But remember, while a high dividend yield can be enticing, it's not the only factor to consider. Other aspects like the company's overall financial performance, its growth prospects, and market conditions can also influence the attractiveness of a stock. Thus, dividend yield is a crucial metric that helps investors assess income generation and a company's financial health. Before we continue, don't forget to smash that like button if you enjoyed the video. It really helps out and shows us what content you love. Also, hit subscribe and turn on notifications so you don't miss our next awesome video. Drop a comment below to share your thoughts or any topics you'd love to see in future videos. Now that we know what dividend yield is, let's delve into the factors that can affect it. The first factor that comes to mind is a company's financial performance. Earnings and profits are the primary sources of dividends, so it stands to reason that a company doing well financially would have a higher dividend yield. However, it's not just about the current financial situation. Investors also look at a company's growth potential and future earnings prospects. Next up is the company's dividend policy. Dividend policy is a crucial determinant of the dividend yield. Companies that consistently pay dividends are often seen as more financially stable and can offer a higher yield. On the other hand, companies that retain their earnings for reinvestment may offer a lower yield. While these factors are internal to the company, there are also external factors at play. Market conditions can significantly influence a stock's price, and since dividend yield is calculated as the annual dividend per share divided by the stock price, changes in the market can directly affect the yield. For instance, when stock prices fall during a market downturn, the dividend yield can shoot up, even if the dividend payments remain the same. However, it's important to note that a high dividend yield is not always a good thing. It could be a sign of a distressed company with limited growth potential. For example, if a company's stock price is falling due to poor financial health, it can result in a higher dividend yield. But in reality, this might be a red flag for investors, as it could indicate that the company might not be able to sustain its dividend payments in the future. The average dividend yield on S&P 500 companies historically ranges between 2 and 5%. While this may seem modest, it's crucial to remember that dividends are just one part of the total return equation. When combined with capital appreciation, the total return can be much higher. Keeping an eye on these factors can help investors make informed decisions about their dividend investments. Understanding these factors can not only help investors choose the right stocks, but also manage their expectations about the potential returns from their investments. A dividend yield can be of different types. Let's explore them. When we talk about dividend yield, we are generally referring to two types: historical yield and forward yield. Historical yield, as the name suggests, is based on the past. It's like looking in the rearview mirror of your car to see the road you've traveled. In the context of investing, it refers to the dividends a company has paid out in the past year, relative to its current stock price. To calculate it, you simply divide the annual dividends paid per share in the previous year by the current market price of the stock. On the other hand, forward yield is all about the road ahead. It's like using the GPS in your car to predict the route you're going to take. In the world of investments, It refers to the projected annual dividends a company is expected to pay in the upcoming year, relative to its current stock price. The calculation is similar to that of historical yield, but instead of past dividends, we use the expected future dividends. Now you might wonder, why do we need two types of yields? Well, each type serves a different purpose and provides unique insights. Historical yield gives us a sense of the company's dividend track record. It's a reflection of the company's stability and its commitment to rewarding shareholders. On the other hand, forward yield is more about the company's future prospects. It's a glimpse into the company's strategy and its anticipated financial health. It's particularly useful for investors who are more focused on future income potential. However, it's important to remember that while historical yield is based on actual data, forward yield is merely a projection. Therefore, it carries a degree of uncertainty and should be used as part of a broader investment analysis. Understanding these types of dividend yield can help investors maximize their returns. A high dividend yield can be attractive, but it's not always a good sign. Let's find out why. Dividend yield is a metric that grabs the attention of many investors. This is primarily because it provides an indication of the potential return on investment in a stock. The ratio of the annual dividend per share to the stock's current market price, when expressed as a percentage, gives us the dividend yield. It's a useful tool to gauge income generation and the company's financial health. Now let's consider the potential benefits of a high dividend yield. The most obvious one is the potential for a substantial income. This is particularly appealing to income-focused investors who are looking for regular returns on their investments. In addition, high dividend yield stocks can also offer a sense of stability. After all, a company that consistently pays dividends is often seen as financially healthy and reliable. However, like with all things in life, there's another side to the coin. A high dividend yield could also indicate a ceiling on growth opportunities. Why, you might ask? Well, when a company is regularly paying out large dividends, it could indicate that the company has limited opportunities to reinvest its profits for future growth. Instead of using those profits to expand or innovate, the company is returning them to shareholders. While this isn't necessarily a bad thing, it could limit the company's future growth prospects. Let's put this into perspective with an analogy. Think of a company as a fruit tree. A tree that's constantly being picked clean of its fruits may not have the energy to grow bigger or produce more fruits in the future. Similarly, a company that's constantly paying out high dividends may not have the resources to expand and grow. Moreover, a high dividend yield could be the result of a declining stock price. Remember, dividend yield increases as the stock price decreases. So a high dividend yield could actually be a sign of a struggling company. It's like seeing a big, juicy apple on a tree, only to find out the tree is sick. Therefore, while a high dividend yield can be enticing, it's important to consider the broader financial picture of the company. Reinvesting dividends can be a powerful strategy. Let's see how it works. When you reinvest dividends, you're essentially using your dividend income to purchase more shares of the same stock. This allows your investment to grow exponentially, harnessing the power of compound interest. Let's consider a simple example. Suppose you own 100 shares of a company that pays a yearly dividend of $2 per share. In a year, you'd receive $200 in dividends. Now, if you choose to reinvest these dividends, you would buy additional shares with that $200. As more dividends are paid out, you'd have more shares earning dividends, leading to a snowball effect of increasing returns. In the long run, this strategy can significantly boost your investment returns without requiring any additional capital from you. It's like planting a seed from an apple you ate, and then planting the seeds from the apples that grow from that tree, and so on. Reinvesting dividends can thus be a game changer in your investment portfolio. So we've covered a lot about dividend investing. Let's summarize the key points. Dividend yield is a critical metric for investors. It's the ratio of the annual dividend per share to the stock's current market price, and it's expressed as a percentage. This yield helps us to assess income generation potential and a company's financial health. There are several factors that affect the dividend yield, including the company's financial performance, its dividend policy, and the prevailing market conditions. We also looked at the two types of dividend yield, historical and forward yield. Remember, a substantial dividend yield can provide a steady stream of income and a sense of stability. However, it's worth noting that this might also signal a cap on future growth opportunities. Don't overlook the ups and downs of high dividend yield. Sure, it offers a consistent stream of income, but it might also hint at a company that's hitting a wall in terms of growth potential. Lastly, we delved into the importance of reinvesting dividends. Reinvestment can maximize your returns, turning a slow and steady income stream into a powerful compound interest machine. Thank you for watching. Remember, understanding dividends can be your key to smart investing. Until next time, keep investing wisely.